You want to cut through all the financial noise, get right to the important stuff, fast. Well, that's what we do here.
Mm.
Today, we're diving straight into the latest from the Macro Butler. It's called the Comex Show.
Yeah, and this one's definitely not your standard market update. The Comex show, it really drills down into gold. The Comex exchange gives a pretty sharp take on what's shaping things right now.
It does. It mixes, current analysis with history, market data.
A good blend.
Exactly. So our mission today, pull out the key insights from this newsletter, the stuff you really need to grasp about gold and, well, the whole financial picture.
No fluff, just the core ideas.
Right. And this week, the Comex Show starts with, a really provocative idea. It compares today's financial markets to a, quote, dystopian version of The Truman Show.
Wow. Okay, like the movie.
Yeah, exactly like the movie, or even that earlier concept, The Malcolm Show. The idea is someone's living in this totally fabricated reality.
And they have no idea. They're the star of a show. It's a classic metaphor for questioning reality, isn't it? What's real, what's manufactured.
Okay, so how does that connect to finance, to our money?
Well, the newsletter argues that central banks, they're kind of like the scriptwriters. They set the big picture narrative.
Okay.
Then you've got the financial media acting as the PR department, basically spinning the equatorial story.
Makes sense. And the algos, the trading algorithm.
They're the extras, providing the predictable background noise, the churn.
And us, the investors.
We're Truman, unknowingly playing our part in this potentially controlled system.
Yeah.
It's a bit unsettling.
It is. But then the Comex Show throws in a twist, right? It introduces gold.
Yeah, gold is positioned as the quiet rebel in this whole setup.
How so?
Because it has intrinsic value, that long history as a safe haven.
Right.
It's just harder to fully control within that main financial story. It sort of exists outside it.
Which brings us nicely to the price of gold. The newsletter says it's inevitably soaring.
Right. And the reasons given are that classic mix. Massive global debt, ongoing wars, stubborn inflation.
These are the big fundamental forces that usually push gold higher, historically speaking.
And this is key, it's not a straight shot up. The newsletter points out, gold's being kept somewhat on a leash.
How?
Through derivatives, through interventions, mostly happening within the Comex exchange. Think of them as financial tools used to manage, maybe even nudge the price down temporarily.
Ah, okay. So it's not a free market. Exactly.
That's the argument being made. And this is where the Comex show suggests the smart money comes in. The really plugged-in investors.
What are they doing?
They're starting to see through the managed environment, kind of pulling a Truman, like the newsletter says,
Yeah.
looking for the exit.
And they see gold as
As a fundamental crack in the facade, a way out of that controlled narrative.
Okay, that's a powerful image. To really get why this matters, the newsletter zooms out, right? Looks at history.
Exactly. It reminds us that wars, like economies, run in cycles. And driving both. Fundamentally, it's the flow of capital.
Money always follows the action, or maybe anticipates it.
Precisely. From ancient trade routes, colonial expansion, right up to Bretton Woods, capital chases opportunity, and maybe more importantly, gets ahead of big shifts.
They even mention Cicero and Aristotle, don't they? These dynamics are ancient.
They are. And building on that, the Comex show looks at past speculative bubbles. Think South Sea bubble, Mississippi bubble.
Right, those famous manias.
The key point there is that cross-border FOMO, fear of missing out. Investors piled in from all over and then pop, big losses.
Stark warnings from history. And it wasn't just centuries ago.
No, the newsletter mentions the panic of 1896 too. Silver crash, railroads in trouble. Hit U.S. banks hard.
And what happened then?
British capital saw an opportunity. Swept in, bought up depressed assets. Shows how one person's crisis is another's chance.
So bringing this historical view to today, what's the big observation?
The Comex show argues that the most significant capital flow in 2025, despite maybe what you're hearing elsewhere, it's not tech, not crypto, it's physical gold.
Physical gold. Where's it going?
There's a clear trend noted. Physical gold moving out of vaults in London and Zurich
And heading where?
to the Comex in Manhattan.
Okay, why? What's the reason given?
Well, the official line is maybe tariffs, things like that. But the newsletter strongly suspects the real driver is fear. Anticipation of capital controls kicking in over in Europe.
Ah, because in the war in Eastern Europe, getting hotter.
That seems to be the implication. And this movement fits perfectly with history. When war and financial uncertainty rise, capital flees to perceived safety.
And gold is the ultimate safe haven asset, historically.
Right, so the Comex show calls gold the canary in the vault. Again here. It's potentially signaling some deep unease under the surface.
Okay, so this gold is piling into the Comex. Let's clarify what the Comex actually is. The newsletter calls it Wall Street's Gold Casino.
Yeah, that's a good description. It's run by the CME Group, and it's essentially a futures market for gold.
So people are trading contracts betting on the future price.
Exactly. You have the longs betting the price goes up, the shorts betting it goes down. But most of it is just paper shuffling. Contracts get rolled over month after month.
But you can get actual gold,
Right, yeah.
Physical delivery.
You can, but you have to signal you want the real metal and, crucially, pony up the full value by a specific date, the first position date.
So that shows real intent. You're not just speculating on paper anymore.
Right. It's a serious commitment compared to just playing with leveraged futures contracts.
And inside the Comex vaults, there's a difference in how the gold is labeled. Eligible versus registered.
Yeah, think of it like this. Eligible gold meets the right standards, it's sitting there. But registered gold has a warrant attached. It's officially earmarked, ready for delivery to someone who's claimed it.
So an increase in registered gold being called for is the key signal.
That's the idea. It signals genuine demand for the actual physical metal, not just the paper contract.
And is that demand increasing?
Apparently, yes, significantly. The newsletter highlights a big jump in gold flowing into Comex vaults since the U.S. election.
How big?
Around 24 million troy ounces. That's, what, 746 tons?
Wow, that's a lot of gold.
It is, and it's pushed the total gold stockpiles in Comex vaults near 35-year highs, even higher than during the peak of the pandemic.
So what does that suggest? Who's moving all this gold?
The implication is pretty clear. Major players, maybe institutions or very wealthy individuals, are concerned about something coming down the pike. They're actively securing physical gold.
And tracking these delivery numbers, the newsletter says, could be like an early warning signal.
Potentially.
Right.
It could signal a growing preference for physical metal over paper promises, almost like a slow-motion bank run on gold contracts. And this trend of taking physical delivery, it's been building since 2019, and especially picked up post-2020.
We also saw huge delivery volumes recently, right? April was massive.
Yeah, second highest on record. The newsletter suggests that was partly driven by traders exploiting an arbitrage opportunity.
A price difference between spot gold and futures.
Exactly. A chance for a quick, relatively risk-free profit that sucked metal into the delivery mechanism.
But while deliveries were high, overall inventory dipped slightly.
That's right. It suggests some gold has actually been withdrawn physically. But interestingly, unlike back in 2019 when registered, ready-to-deliver gold was scarce, there's apparently a good supply now.
Which leads to the question.
Yeah, the newsletter asks, who's prepping for something and quietly calling in the shiny stuff?
It's also interesting where this Comex gold physically sits. It's very concentrated.
Extremely. Even though tons of contracts are traded, only a tiny fraction ever resulted in physical delivery back in, say, 2018, about 1.6 million ounces.
And most of that physical gold is held where?
In just 3 vaults, Brinks, HSBC, and JP Morgan. And JP Morgan is the big one, holding the lion's share.
So it really points to big institutions making sure they have the physical metal secured.
That seems to be the inference, yes. These big players are getting their physical ducks in a row.
Now, one of the most fascinating points in the newsletter is about the nature of this recent gold rally, the one that started back in February.
Ah, yes, the hated gold rally.
Explain that. Why hate it?
Well, usually when gold prices surge, you see a lot of speculative buying in the futures market. Hedge funds, other big traders piling in, betting on prices going even higher.
Okay.
But this time, it's different. The net holdings of these non-commercial players, basically, their bullish bets are actually at their lowest since March 2024, even while the price has been climbing.
So the usual speculators aren't driving this rally.
Apparently not, which suggests, according to the Comex show, that this rally is being driven more by fundamental factors, real-world demand, safe haven buying, not just futures market froth, hence hated by the typical momentum crowd, perhaps.
And where does the average U.S. retail investor fit into this? Are they buying physical gold?
Not so much. According to the newsletter, they're still mostly holding gold through ETS exchange-traded funds.
Which are paper proxies, right? Not the same as holding the bar in your hand.
Exactly. Less direct, less resilient than physical ownership. And while there have been some recent inflows into these gold ETFs, they're still way below previous peaks.
So this current gold rally isn't really being fueled by Main Street jumping in yet?
Doesn't seem like it. It points again to other forces being at play.
Like geopolitical risks. The newsletter emphasizes those too.
Big time. Things like trade wars, diplomatic failures, they create uncertainty. There's this thing called the geopolitical risk index, the GPR.
And it correlates with gold.
It tends to, yeah. Historically, big jumps in the GPR index often see gold prices rise. The newsletter cites examples like the 2008 crisis, 2016, the Ukraine invasion.
Showing gold's role as a safe haven during turmoil.
Precisely. It's described as an anti-fragile asset with zero counterparty risk. In times of conflict or crisis, that's incredibly valuable.
Which loops back to that idea of gold moving from Europe to the US.
Right. The argument is that smart money sees the writing on the wall in Europe, potential capital controls, the war escalating, and is moving gold to the relative safety of the U.S., specifically into Comex vaults.
Following that historical pattern of capital flight.
Exactly. Plus, you have political instability in Europe, rising tariffs, factors that could contribute to sovereign debt problems there, adding another layer of risk.
The newsletter also spends quite a bit of time on China's role, doesn't it?
Oh, absolutely. China's becoming a huge force in the gold market.
What's driving their buying?
A couple of things mentioned are falling property prices domestically and a devaluing currency. So strategically, both the state and individuals are turning to gold.
And we see that in investment flows.
Yeah, strong inflows into China-focused gold ETFs. And the newsletter draws a potential parallel, suggesting the U.S. might see a similar rush when investors grasp the need to preserve wealth during a possible Trump stagflation scenario.
China's buying power is really shifting the global balance.
Undeniably. And there's this amazing little detail included.
What's that?
About the Chinese military, the PLA. Apparently, they've had their own dedicated gold hunting squad since 1979.
Seriously, a military unit looking for gold.
Yeah. And they've reportedly found a massive amount, like over 1,800 tons, helping make China the world's top producer. The PLA even helps protect gold shipments.
That really underlines how strategically vital China views gold.
It absolutely does. It's not just a financial asset for them.
So let's tie this back to the Truman Show analogy. How does the newsletter wrap this up?
It basically says, look, many investors are watching the Comex show the futures prices, the paper trading.
Like watching the movie.
Right. And they're missing the real-world action. The glittery paper facade of the Comex is distracting from the strong underlying physical demand, especially from places like China.
So the record prices, the strong physical buying, that's not coming from the usual ETF crowd.
Not primarily, no. The conclusion is that the Comex show might be, well, a managed performance, while the real story is unfolding in the physical bullion market.
Okay, so given all this, what's the strategic advice? How should investors think about positioning themselves?
The newsletter argues for a fundamental shift in focus, away from just return on capital.
To return of capital, basically preserving wealth.
Exactly. Especially as this war cycle potentially heats up. The core recommendation, own real assets.
Right.
Primarily physical gold and silver, described as the only truly anti-fragile assets. Holding other commodities is also suggested.
What about cash and bonds?
For cash management, stick to short-dated, high-quality U.S. dollar bonds and T-bills. Keep it safe and liquid.
And equities, stocks.
Favor companies with low debt, strong financials, particularly those in energy and commodity production. It's a defensive posture, really, aiming to weather volatility and get through a period of potentially dull inflation-adjusted returns.
So the key takeaways really hammer these points home. The Truman Show 2.0 idea, gold piling into Comex for hoarding, not just hedging.
The Comex as mostly a paper game, but with growing physical interest, that hated but fundamentally driven gold rally.
Gold's role during geopolitical stress, China's dominance.
The shift to return of capital. Physical gold and silver as hedges against governments and bankers. They even call them hedges against collective stupidity.
Strong words. It also mentions long-dated treasuries are basically uninvestable now.
Yeah, very wary of duration risk there. Prefers short-term investment-grade corporate bonds for fixed income exposure. Expects higher volatility generally.
Then there's the how to trade it section. It connects the S&P 500 to gold ratio.
Right, suggesting that despite the current inflationary boom, an inflationary bust might be closer than many on Wall Street think.
The advice is stay calm. Use the data.
Recognize that capital flight from Europe is likely pushing up both gold and the U.S. dollar, which is interesting. Normally, they move opposites.
It also suggests rethinking where you hold assets. Custodianship, maybe safer regions, certain U.S. states.
Yeah, a nod to jurisdictional risk. And predicts the Dow Jones might outperform the NASDAQ because of these foreign capital inflows seeking safety.
And crucially, it repeats that gold and the USD are likely to rise together during this shift to an inflationary bust.
A scenario most Wall Street forecasts are apparently missing.
Finally, the newsletter ends on this powerful note about true autonomy.
Yeah, it questions just how anti-fragile U.S. assets really are, given how the U.S. dollar itself has been, weaponized globally.
So what provides true autonomy?
The argument is owning physical gold held outside the centralized digital financial system.
Why?
No compliance hoops, no digital IDs needed, zero counterparty risk, no reliance on potentially fragile centralized systems.
Contrasting it with digital assets.
Right. Emphasizing gold's millennia-long track record of protecting wealth against currency collapses volatility and centralization.
And the final line?
Gold matters yesterday, today, and especially tomorrow. Leaves you thinking.
It really does. So this deep dive into the Comex show paints a picture of, well, maybe needing to look beyond the surface narratives in finance.
Absolutely. It suggests there might be divergence between the show being put on, particularly around Comex, and the fundamental reality playing out in the physical gold market, driven by big global forces.
It definitely encourages you to think critically about what real financial security and independence look like in this increasingly complex world.
It's not just about watching this show, perhaps. It's about understanding the stage, the script, and maybe, just maybe, considering your own strategy if the curtain falls differently than expected. What does your offstage reality look like?